Jerome Powell makes a semi-annual visit to Capitol Hill, and it's fireworks, ladies and gentlemen, as Wall Street traders said, no way, we don't like what you have to say, Powell. We saw the Dow down 570 points. We're now at a loss for the year in 2023, despite January's big run-up. What do we do from here? Well, we have all the answers for you on Buy, Hold, Sell. Welcome, everyone. I'm your trader, Todd Schoenberger, and I'm joined by my friend and co-host, Tobin Smith, out of sunny and hot Scottsdale, Arizona. And we have a very special friend with us who is someone who was with us back in our Fox News days. David Nelson, strategist for Belpointe Asset Management and host of the Money Runner podcast. David, welcome to Buy, Hold, Sell.
Hey, thanks so much for having me. I really appreciate it.
Geez, I have to get closer now because you guys are like staring in the camera. I don't want to be the little pinhead in the back.
Well, this brings back so many memories. I mean, this is like back in the B&B days, and I don't want to say the name because I don't want lawyers giving me a call. But
I feel like I'm in the green room.
Yeah, exactly. But those were some great memories and some fun times. But David, I mean, you've been in the markets for some time now. I gotta say, I mean, big sell-off, but was it a big surprise? Powell talks about inflation, saying he still wants to hit that 2% target. We expected probably more interest rate hikes, yet Wall Street said no way.
We probably should have. And, every so often, Powell's got to step up to a microphone. He's got to splash some water on our face. I think what we learned out of all this is that we're still hostage. We're a hostage, hostage investors to the Federal Reserve.
Yeah.
And we have so many things to deal with. You look around the planet, every corner of the planet is still a geopolitical hotspot, but the risk-free rate really matters. And Jerome just reminded us of that today.
Todd, yeah. I got to tell you, first off, it's great to see David. When he was first on the Bulls and Bears show, he actually had hair down to his shoulders and he tied it in a bow tie.
I had cut it off by that time.
Oh yeah, all right. Well,
there was a time in my life I had a real life.
Yeah, he was the only rock and roll star who ever became a star money manager that I know of, and so it is great to see him. Now, if David wasn't so busy, he probably would have been. I need to get you on our mailing list, by the way. Dude, Todd, what is it? I'm now the Mr. Broken Record.
Yes,
10 million jobs for every 5 million people available. Yeah. Here's the one that got me today. I've tried to do. I have this spreadsheet now of all the possible breathing human beings who could work in the United States and all the jobs that are available. 1.8 million people from 2020 at age 62 went on Social Security. We've never had anything like that in the modern age. To pull your Social Security at 62, assuming that they're not exactly high income workers, it means they would have to work, I would think, but yet they're not. Then we have another 1.8 million doofus 18 to 29-year-olds who are not working. They're not out of the labor force. They're not injured. They're not on disability, etc. They're just living downstairs, smoking bongs and playing video games. So there's almost 3 million there that are missing from the service industries. So how on earth, finally, Powell said basically what he has to say. By the way, the Cleveland Fed put a report out on Monday that if you look at the last paragraph and you haven't fallen asleep yet, it says, quote unquote, the only way that the American economy could cool down enough to get to a 2% PCE core rate would be with a recession. And that was the first time I've seen that from anybody who actually spoke the truth and not Fed speak malarkey.
Well, the market's actually predicting that. I mean, right now, if we don't get a recession somewhere on the tail end of this, it's going to be the first time in a half century that a yield curve this inverted got it wrong. I mean, the Fed always goes too far. And the problem that I have with the Federal Reserve is really this. They don't take into effect the lag effect. And even one of their own members, Atlanta Fed President Raphael Bostic, he wrote a paper on this last November, and it stated that it takes about 18 months to 2 years for the rates to wash through the system. We're not even a year into this. So what's going to happen, when we keep hiking, they finally get to their 2%, but they're going to bury the economy along with it.
Well, also, let's also not forget that, I first off, David, I get pissed off at these historical references like the 80s, 90s, 2000, and particularly the last 3 years have anything in common. Yes, it's the United States. Yes, we have an economy, but we've never come out of a pandemic, a post-pandemic, a World War III, and then Fed hike rate. So when you say, well, the calendar says that the stocks are supposed to be going up the first 3 months of a presidential year, really? Did that ever happen after a pandemic? So it's like people like this. No. Denial is not a strategy. And finally, today was interesting that he actually said the words that people were saying they were not going to do that. Remember what 3 weeks ago, David, wasn't the narrative? Well, we're going to have that pivot in September, October. They're going to start cutting rates. How's that possible?
Yeah. Well, you're not hearing that any longer for a number of reasons. But I think that's what's so dangerous right now is that you had that narrative that was out there about this pivot, and it was almost as if the Fed took that and felt the pressure to say, okay, let's start hiking 25 basis points. And the idea was just one more rate hike, which was going to occur at the March 21st, 22nd meeting. Then Goldman Sachs comes out and says, nope, you're going to have 3 more rate hikes. And then you start hearing the chatter saying, no rate cuts at the end of this year, because there were so many that actually suggested we were going to have rate cuts in the fourth quarter. Now there's a speculation we're going to see rate hikes for the rest of this year, and start talking about rate cuts. We're so far beyond that story. That's probably a story well deep into 2024.
6% terminal rate. If you do the math the way I do it, and I do excellent math, is the only way that you destroy enough jobs so that service wages and shelter costs would come down, because shelter wages and service prices are 56% of all the PCE index. If those things don't come down to 2%, we don't get to 2%. I mean, it's just literally mathematically impossible. And nobody wants to tell the truth except this show, Todd.
That's right. This is
the truth.
We are truth tellers. Real quick for the viewers and for the audience, the PCE, the next reading of PCE actually doesn't come out until the 24th, which will be 2 days after the Fed meets. Right. Now, the Fed, what are they going to be? What data point are they really staring at? David, I got to bring it back to you.
I think
we have
it's
the jobs report Friday.
You got a jobs report Friday, and the following week you got a CPI report. I'm not sure if we have a PPI report. That I actually think the CPI is a major event for us. That's kind of what started all this, even before we started looking at the PCE. And we've done a lot. I mean, if you think back where the CPI was last year, and we're down to about 6.4 was the last reading, but going from 6.4 to 2. I personally don't think we get there. I think somewhere along the line, the Fed is going to learn to live with something like 3, or somewhere between 3 and 4.
He seemed pretty determined today, though. I mean, he's on Capitol Hill saying,
David,
talking to the senators,
I
saying, no, we're sticking.
Well, he's got a pretty robust, the numbers are still good. Although the GDP now numbers, the Atlanta Fed, I get it on my app every day. It's come down for the last week. It's already down. It's down almost a full percent in just the last 2 or 3 weeks. We were looking at about 3%. We're now down to, I think it's 2.1 came in today.
Right, remember, you're talking about GDP, David. You're not talking about inflation. You're talking about their
I'm talking gross domestic product. The activity in the economy that's starting to come down. They're gonna have to keep an eye on that. So, it's a big challenge. Going from where we are, we've made some progress, but going that last mile, that can take some time. And to your point, Todd, is, I think the markets actually did a pretty good job getting rid of the rate cuts, because I follow interest rate futures and the terminal rate, that used to be for July. We used to think that July was going to be the terminal rate. It's now September. And there are no rate cuts priced in at all, not until sometime next year. What markets weren't ready for is the idea that the terminal rate would keep going up. And now you look at it as a chart, it almost looks like a tech stock that you want to buy.
Right.
It's pointed 45 degrees, angling up to the right.
Yeah, we
it looks beautiful.
That a Viagra chart in our house. That's a Viagra chart like that.
It just looks like it's on a path to 6%, and that's just pretty tough. And if you start with the risk-free rate as a valuation metric, then if you can get risk-free 5% on your cash, then before you're going to invest in equity, you've got to get something like 3 times that at least before
David,
you're going to risk
David,
your capital.
That's a great point. So we've been about 60% in cash for the last 10 months, at least 12 months. And then we've been picking our little micro sectors. Like our actual portfolio is up about 32% this year, being 60% in cash. Now, one thing is we're getting 5% yield from iBroker in a money market account. And to your point, why would I throw away a risk-free 5%, reinvest the dividends, et cetera, and then go out and buy tech stocks? On the other hand, as you know, ChangeWave is new name was Transformity Research, started after I sold that to SG Global, and but there's micro niches, and so the big transformational changes that have been going on that are investable really have had nothing to do with tech until Chat AI started. We've made 30-40% on owning product tankers that ship oil and ship diesel. Why? Because the transformation of the Russian energy business opened up this huge opportunity, and rates are up 400%. I'm not saying anybody can't make money in the market now, but you have to be in niches, in my opinion, and not the broad indexes. It is, if it was ever a stock picker's market, David, right now is a stock picker's market.
Well, I think it's a great point. If you think back over the last decade, all right, it made it very difficult for guys like us as money managers, because the tide lifted all boats. Everything went up, and the bigger you were, the more you went up.
Buy the QQ on the dip, right? It averaged 18 to 22%.
I look underneath the market today, and the dispersion between good and bad is pretty wide. And that to me is an opportunity. So there are things out there to buy. There are themes you can buy into. Just the broad index, it's got like kind of an anchor on it right now, and it's just going to be for a while. We're going to have to live through this, probably another 6 months.
Manager, if a person is an active manager right now and they are not beating the market, then what the freak are they in the business for? Because this is the time where active management is supposed to make the money. You're supposed to say, hey, here's the value added that I bring to just buying the indexes. And I guess my argument is, I've recently joined, we sold our company to True Market Insiders, and they have a huge amount of data, and they do a great job of indexes. What I'm building with them are sub-indexes. So in the transportation index, we have a product shipping deal. We have a bulk shippers. We have other, because those things are on an uptick. They're an S-curve inflection point of rates going higher because there's not enough boats to ship all this stuff, and they got to go 2 times farther. Well, that's a very microeconomic world. But
yeah,
I'll take being up 32% net of fees.
No doubt. And you're doing sensational. Listen, so let's leave it there on this block, because coming up in the next block, I really want to get your opinions on the jobs report. If we do have a big beat on Friday, what this could possibly mean for the Fed rate hike when they meet in 2 weeks.
Good news, bad news, or bad news, good news? I don't know.
Well, we're going to answer that for the audience after the break. There's a great teaser for you, so please stick with us. We'll be right back.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russian doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back to Buy, Hold, Sell. So today was a big off day after Jerome Powell's comments to the Senate Banking Committee on Capitol Hill. We saw the Dow down over 570 points. We're now at a loss for the year. What's going to happen going forward? Well, guess what? Chairman Powell has another day on Capitol Hill tomorrow, so we will see. Plus, we have the upcoming jobs report to talk about. And speaking of with that, David, I want to go back to you on this one, because on that jobs report, the consensus on Wall Street is 225,000. Last month, or January, we had 517,000. We had Gina Martin Adams from Equity Strategist from Bloomberg on the other day. And one thing I pointed out to her was 225,000 is still an eye-popping number, especially in a recessionary environment. If we beat that number and we see the market slide even further, will this force the hand of the Fed in 2 weeks to actually raise maybe a little bit larger than the 25 basis points that's expected?
Almost anything can happen with these guys. I think the number's got to get down to about 100,000 on a sustainable basis. Anything more than that, you got a problem. And the Fed understands that. They want to see it somewhere. They don't want to see it go negative, but they don't want to see it much above 100,000. Right now, you said it was 225. I hadn't seen that. You get another number like 400 to 500.
Oh wow, yeah.
That would be a real negative for stocks. And then you got a CPI report literally a couple of days after that. So
yeah,
look at, there's no shortage of bricks in the wall of worry.
Well,
yeah, you got that right,
Todd. The other thing is somewhat, I know this is again a little bit in the weeds, but January had a bunch of seasonal changes that we've never had before. And I think there's a reasonable argument to be made that thing was so off the chain. I mean, 5 orders of magnitude higher than what was expected, tells me that the seasonal adjustments that changed in January probably overstated a little bit, but it is what it is, right? The seasonal adjustments you're going to have, you can get all the weeds you want, but it would just be, just go someplace. We were out last night, packed. There was it's a place that's within walking distance of our home area. Every restaurant on a Monday night was packed. There was no Monday night football.
Nothing going on. There's nothing going on. But
talk to friends, so on and so forth, saying, "I just got off a boat. Holy Christ, the thing was packed. I just got out of Hawaii. We missed this flight because no one like me actually works except for me. All my friends are out freaking spending the money and."
No, it's that way too here, Toby. I walk into the restaurants. I got to make a reservation 2 days in advance, even for Greenwich, Connecticut. This isn't like Manhattan.
Yeah.
It's a little busy here, but I suspect it's that way pretty much around the country. So the economy, there's fair amount of steam, and there's still a lot of liquidity out there, and there's still a lot of government cash that is sitting in people's bank accounts that they've got still got money to spend.
Yeah, good point about that. So, David, you being the strategist at Belpointe Asset Management, you're a podcast host with the Money Runner. I mean, you're right there. You got the finger on the pulse of what's taking place in the markets. What are you telling people right now as far as specific stocks or maybe sectors that they should start leaning towards?
All right, a couple of things. I'm going to break it up into two segments here. One, I'm telling don't put all your money in stocks. You got choices right now. It used to be that there was no alternative. There are a lot of alternatives right now, and the first of them is cash. Right now, you can put money in a 1-year T-bill. You're going to get over 5%. You can ladder out a portfolio 3, 6, 9, 12. Maybe take it out to 2 years. So part of your money should be right there. But right now, in terms of equity, maybe the only area of the market I'm not invested in right now in some fashion is REITs and utilities. I'm quantitative by nature, rules-based. So from a fundamental standpoint, estimate revisions, kind of wonky stuff, very important to me. I need to look at companies that are seeing those estimates going up, not going down. Valuation is certainly part of it. But when I do that, I'm finding things even within technology that I'm attracted to. Last year was about free cash flow, and that worked great. This year, it's about estimate revisions. So that brings me to names like Arista Networks. It's a name that's done very well for us. And some off-the-wall stocks as well. I mean, it normally wouldn't have fallen into the quant model, but a company like Twilio, and I grant you this is high octane, but when I see the CEO go out and buy $10 million worth of stock, that's not a token investment. That's serious money. $10 million as an investment. He's only bought twice in the last 10 years. Amen.
Yeah, David, he's got $10 million in his socks, BTW. But David, I'm with you. I find it intriguing that people are. Somebody brought in an account a couple weeks ago, and they had like office REITs. Are you kidding me? I mean, we have Blackstone now foreclosing on 6 different offices in New York and in DC and LA and so on and so forth. Of course, San Francisco, because they own the one that Twitter decided not to pay the rent on. And it blows my mind. And even apartment REITs, I mean, certainly at the high end, we're talking about, everything being busy. Obviously, there is a stratification in the United States that's gotten even larger, which is, remember, the top 10% pay 65% of all the taxes. The top 10% own about 80% of all the wealth. Top 10% is kicking ass. And Greenwich, Connecticut, and North Scottsdale, not so much Buffalo, Todd, are all, at the high end of the space. You get into the heartland is where we have a lot of subscribers, and they're saying, man, if you're in the farm industry, one of the things we're buying now is farm, AGCO, Deere.
I own AGCO.
They're making more money than they ever have. And the management and the technology is so impressive that you're able to in the heartland. By the way, there's this great book out that I'll think of in a second that reminded me that, remember, the whole United States grew because we had the most fertile land in the world, and all those people who came over from Europe from these small little plots of land could now have 50 acres and a mule. And that's how we got going. But we're not only the strongest energy supplier to the world, we're the largest food supplier for high-end grain and corn. And
I think of those investments, Toby, as they're the new tech, because you look at some of the machinery that these companies like Deere and others are manufacturing. It's pretty impressive stuff. One, you're looking at tractors that are driving themselves. All right. So that whatever it is, a harvester, a planter, the planter technology is the most interesting to me. They've got it down to a science where they can determine to within very, very small measurements, how deep the seed is going to go and the spacing between the seeds. They're driving 10 miles an hour. That's pretty fast to lay this stuff down. And I never knew how important it was to a farmer to have that be exactly right. If it's 2 inches instead of 4 inches, it's a huge difference in terms of the crop yield. And when you're talking thousands and thousands of acres, it's a big deal.
Yeah, and then of course you add on the technology that shows how much fertilizer you should put on. And again, fertilizer is the most expensive part of the whole friggin' thing, particularly nitrogen. All of a sudden, again, like AGCO and Deere both have these systems that essentially look at the dirt, look at the side, I'll make all these calculations, and then give a smidge of nitrogen, as opposed to the old days when I used to work for Cedar Life Insurance. It was in Des Moines, Iowa, and when I'd go back in harvest time, I'd say, "Take me out," because I'm a city boy. I've never seen how the hell did this corn get to be 25 feet tall in Des Moines, Iowa? And the answer is a shitload of fertilizer, son. And that's when fertilizer was cheap. Well, it's not cheap anymore. So I'm with you, David. I mean, again, I think it's a great opportunity, and you only buy AGCO and stocks like when these guys are making money hand over fist, because unlike the rest of the people, those people actually save money because they actually save for a rainy day. I mean, literally. And so when they have excess cash, they don't have any divorces. They don't have like alimony to pay. They don't have any of this stuff. They're farm people who, with the richest 2% of people in the United States are farm owners. So, I love it.
And it used to be a time when, the farmers, a good year was breaking even. That was a great year. All right. Now they can make some really serious money because they're using science to make these things a lot better for all of us.
Yeah, we'd be talking about AGCO on a sideshow.
Well, I mean, there's so many other stories to this. I mean, something that chicken farmers. One thing with Tyson Foods, once they realized that they could put LED lights into these chicken coops, that actually helped their chickens, because chickens are notoriously stressful, but the LED lights seemed to calm them down. They lost less feathers. They were plumper. Yeah, the whole thing, right? So they invest. No, seriously. So they invest in these light bulbs. They're more expensive. Next thing you know, Tyson has their per unit the production was much higher, and then they were making more money. So there's lots of angles on the farming side, and it's one of those areas, obviously, that's never going to go away. So I see a lot of value there. David, let me ask you this. So now you have yields that have popped. We saw the 2-year yield up to 5%, first time since 2007. I mean, you can only suspect that tomorrow, especially when Powell visits the House of Representatives, which I would think would be a little bit more of a gregarious type of tone, because the reps like to, yell and scream a little bit more than the senators, I believe. But with that, if yields do continue to move higher, and then it just seems that much more advantageous for an investor to move there. I mean, are you suggesting any type of yield-friendly investments for investors?
Yield-friendly investment. Wow.
Yeah.
I actually think that you're going to have a major opportunity in bonds on the long end of the curve.
Yeah.
The 60-40 portfolio is going to come back in a very, very strong way. And, you know, we abandoned fixed income for the last decade because there's just no value there. But balancing out your portfolio with the longer end of the curve is going to be more attractive once this settles down, so that when we hit a recessionary environment, you're going to make some money on bonds to make up for the fact that you're losing money in your stock. So I actually think the 10-year is actually starting to get to an area that I find attractive.
Well, Todd, you know, the other thing that's interesting to me is that I started in 1981 and people lost, this is a technical term, a shit ton on their bonds as interest rates went up, right? And
did you go to Harvard? Did you go to Harvard to learn that term?
Exactly. I wore suspenders when I was 11 years old. Okay, that's how I went. So in Europe, I mean, people forget that Europe is still the biggest buyer of our 10-year bonds because their yields are so low and they have actual pensions that they pay people. They lost their tuchus, right? They lost their butts on, they were down 21% on bonds. So they're underweight bonds. And the one hope I guess you'd have for the stock market is obviously kryptonite is above 4% on 10 years all of a sudden. But these guys are going to be buying these bonds because they don't have to mark to market the values. We'll get to in the weeds here. But there's a big demand if we can get to 4 to 4.5. And now they're going to buy bonds, which means the prices are going to go down. Yields are going to go down.
You know,
it'll you know, that's one hope I have is when people can feel comfortable to go out and buy a bunch of bonds.
I actually think that you're going to see a pivot point. I personally think the pivot point is around July.
I do
and
too.
I don't mean that the Fed is going to wake up one day and start to cut rates. I think the pivot is from this sense. Right now, we're in an earnings recession. At best for 2023, you're looking at what we did last year. Mm-hmm. And it's likely something less than that. Mike Wilson is looking for 195. Consensus right now is still 223.
Earnings on the S&P 500.
On the S&P 500. If we get to July, we'll be beyond the debt ceiling, all right, which is another headache that we haven't even discussed, all right? Well, beyond that, but then fund managers and portfolio managers like myself, we're going to care a lot less about 2023. We're going to be looking at 2024, and the 12-month look ahead for earnings is going to look a lot better. We're going to actually be looking at some growth instead of things being revised down.
Yeah. David, you make a great point. Again, I'm very prejudiced against money managers who are under 45 years old because I don't think they have a clue about, you know, what Volcker had to do to get rid of inflation. How people were yelling and screaming, "Oh my God!" And I was selling bonds for Kidder Peabody in 1982, and I would walk into the manager's office and they say, "Get out, get out." We're losing our ass on bonds, you schmuck.
That sounds like last week.
Yeah. So, but it worked. It took a lot of pain, but it worked. And to your point of, you know, when we added $6 trillion of cash to the money supply, and then the Federal Reserve, the federal government added another $6 trillion. You added up, that's a lot of trillions, right? That's like 60% of the entire GDP for a year. So that caused inflation. Larry Summers was right. God bless him. But what really concerns me, David, is we're not quantitative tightening is nothing. They've done 400, 500 billion. There's 6 billion of cash sloshing out there. How do we get inflation down if we don't start actually really tightening the monetary supply?
Well, they're tightening a little bit. I mean, they're starting to roll off the balance sheet, but now you're talking government, and that's the Achilles heel, because these guys just cannot get their act together. I mean, Congress is just this side of dysfunctional. All right. It's about the only agreement there is that we got to get rid of TikTok. Out of all the things we got to worry about, the only thing these guys can agree on is about a Chinese balloon and TikTok as the biggest problems in the world.
Something that they've
We got
never
some pretty
seen
big
before.
problems out there.
Yeah, I saw one of the congressmen. The reporter was holding up like his iPad to show TikTok, and the guy says, "What's that?" It says, "That's TikTok." Oh, that's TikTok.
Yeah. I thought
it doesn't have any
today.
grandkids or kids, obviously.
Yeah.
But by the way, if you want to learn something about stocks, go on TikTok. There are some experts there that really are slaying it.
Yeah. Well, the fact that our congressional leaders even need to have the discussion to get rid of TikTok because they are concerned that they might lose the under 30 vote is ridiculous. That they're actually going to make that
obscene.
decision.
Yeah, I saw that.
Yeah.
That's just awful.
Yeah, I'm with you.
Definitely is. So listen, we're going to leave it there, guys. So on behalf of CrossCheck Management, oh my goodness, I'll end this later on. I'll have to read through the sending. So
Todd, get off the meth, man. Just say no, brother. Just say no.
I know, right? I know. All right. So David Nelson, Chief Strategist for Belpointe Asset Management and host of the Money Runner podcast. We want to thank you so much for joining us today on Buy, Hold, Sell. We do hope to see you again very soon, and not as long as it's been since we last saw you on the last show on BNB.
Thanks so much. Can't wait to come back.
Absolutely.
That's great to see you, David.
So on behalf of David Nelson and Tobin Smith, I am Todd Schoenberger. Thank you again for joining us for Buy, Hold, Sell. We'll see you again next time. Take care.
Buy, Hold, Sell, brought to you by CrossCheck Management. Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello.
Financial News TV, just the way you like it. Fast-paced, unadulterated, in-your-face, rock and roll style. Join us next time on Buy, Hold, Sell Live.
Oh, yeah, I'm going to remember all that. I can't even remember.
Oh, God.
Yeah, well, that doesn't. I want you to, oh, my God. Fast-paced, no. Oh, sorry.
Take one.
Fast-paced, no holds barred, in-your-face, rock and roll style.
Woohoo! Let's kick some
I want you to smash that like button.
Track, cue, dissolve.
Good morning and welcome
from Bigwig Studios. From the Bigwig Media Studio.
Bigwig Media's broadcast center at the Willard is the ideal headquarters to host your virtual meetings and video conferences.
Kudos to our team who's running around behind the cameras.
What I liked about working with Bigwig Media was you guys are the experts.
Our industry pros have you covered. Let's get started.